In this video, we are going to do an analysis of Amazon stock to see if it's a great business. Obviously, it's a great business. We'll understand why it's a great business and also if it can be a good value, a good price now to invest in this company. So in this video, we'll talk about the business, of course, the numbers of the business, the quality, is it a quality business or no, and of course, the value of the business. So here's the last event about Amazon. I think the main one is Jeff Bezos is back, especially to have a focus on AI. He's coming back really to focus on the AI part of the company. So I think it can be something very promising for the future because they are well placed for this. Okay, then they have significantly outperformed the market in 2024 with 54% return. So it's almost like double that the market produced, like the S&P 500. They have big growth expected, especially for AWS, and the profitability of Amazon is like growing like crazy thanks to AWS and also the advertisement revenue. So here it will be a good analysis. Here we can see what it does against the S&P 500, and we can see that it doesn't really outperform. I mean, it outperforms the market, but not from a lot. Okay, little outperformance, especially when we compare to other companies in the tech, but it's still an outperformance, so it's good. What about the history of the company? It was founded in 1994. By Jeff Bezos in Seattle, Washington. Initially, it was an online bookstore. Okay, in 1997, it went public with its initial public offering, the IPO, on the Nasdaq stock exchange under the ticker AMZL. In 2005, Amazon Prime was launched, offering customers free 2 days shipping for an annual fee, which later expanded to include various digital services. Like the 2 day shipping already in 2005 was really like kind of visionary. Okay, like still in 2025 today, you still have some websites that are telling you will need to wait 5 days before getting delivered, even if it's in the same country where you live and so on. So 2 days shipping in 2005 was already like a big deal. In 2006, they created Amazon Web Service, offering IT infrastructure service to businesses in the form of web service, now commonly known as cloud computing. And in 2017, they did the acquisition of Whole Foods Market for $13.7 billion, significantly expanding its presence in the grocery stores. So how does Amazon earn money? They have online store. Okay, this is an Amazon core e-commerce business where it sells a wide variety of products directly to consumer through its platforms. This includes everything from books and electronics to clothing and household goods. They have a subscription service. Okay, this includes like Amazon Prime, which offer benefits like free shipping, streaming of movie and music, and other exclusive deals. It also includes subscription for service like Kindle Unlimited or Audible. Okay, I have all of this. I have Amazon Prime, I have Audible. I don't have Kindle Unlimited, but I have 2 of those services, so I like it. Then they have AWS. It's like a cloud computing division offering a wide range of services, including computing power, storage, and databases. AWS is a major profit center for Amazon, providing scalable and flexible cloud solutions to businesses and governments worldwide. Like, they have government as a client. And then they have advertising. They earn revenue by selling advertising plan on their platform. Brands and sellers pay to promote their product and service on Amazon's website and app, leveraging Amazon's vast customer base. They have, of course, the Amazon Marketplace, but they also have a Twitch in this. So who has a client? You have B2B clients, okay, especially for AWS, including startups, large enterprise, and government agencies providing cloud computing service. Companies that use Amazon advertising service to reach consumer on Amazon platforms, and business that use Amazon platform to sell their product to consumer. These can range from small businesses to large brands. Okay, they also have B2C. Customers that are individual consumers who purchase a wide range of products from the Amazon Marketplace. These include books, electronic, clothing, household items, and more. Okay, here's the sales by country is like 61% North America and 39% international. By product, it will be 40% online stores, 24% third-party sellers, 16% AWS, 8% advertising, 7% subscription, and then others. The market, here you can see that Amazon is a leader in cloud infrastructure. They have something like between 30 and 40% of market shares. It depends on the source and so on. They have between 30 and 40% of market share in a high profitable market, probably one of the best market for the next 10 years. Then it's Microsoft, 23%, then Google, and then it's other companies. So AWS, okay, the size of the market for this is $600 billion in 2030. In 5 years, it's expected to be $2.39 trillion. It's huge, okay? It's really, really huge. It's more than triple. It's almost quadruple, okay? So it's a growth rate, cumulative annual growth rate of 21.2%. Okay, for the e-commerce business, the size now is 21 trillion and it's expected in 2030 to be 183 trillion. So a cumulative annual growth rate of 27.16%, which is also huge, but is not the most interesting part of Amazon. The most important part is Amazon is leader in cloud, okay, with between 30 and 40% of the market shares. So the team, we have Jeff Bezos, he's back, okay, the former CEO. He developed really like the vision of the company. He's the one who developed all these visions, this innovation, like he is literally a genius, okay. So he's back to focus on AI. Then you have Andrew Jassy, which is the actual CEO. It was a former CEO of AWS. He's in the company since 1997. And I think it's really good that it's him that the place of Jeff Bezos as a CEO, because this show clearly that AWS is the most important thing for Amazon for the next years. So I think this is good. And then you have also Douglas Harrington, which is the CEO of Worldwide Amazon Stores. He joined Amazon in 2005 and CEO of the e-commerce section. You can see that you have CEO of AWS, CEO of Worldwide Amazon Stores. Like, why having this in one company? Because those companies are not separate. Because Amazon, they have been very innovative with this, and everything that they are created, they will consider it as a unique company. Okay. So they will consider AWS as a unique company, different than the Amazon Marketplace, different than Twitch, different than everything. So they have a CEO for all of this, and they all work kind of independently. So that's why they have those distinctions. So the owners now, the shareholders, okay, of Amazon is Jeff Bezos with 8.6%. So it's still a lot. Okay, consider that he left, then of course now he's back, but 8.6% is still a lot. You have Vanguard for 7.6%, BlackRock 6%, State Street 3%, and Fidelity 2.8%. Okay, now when it comes to numbers, first the growth, we have a very good growth of the revenue. Okay, during the last 10 years, it grew at 22% per year. During the last 5 years, we had a cumulative annual growth rate of 13%, and now it's around 10%. For the future, it expects to still grow around 11%. This is data from Guru Focus. When it comes to earning per shares, we had a cumulative annual growth rate during the last 10 years of 47% per year, 24% for the last 5 years, and 90% this year, with an expectation for the future of 37%. And this is mostly thanks to AWS. And the free cash flow, kind of same, 36% for the last 10 years, 14% last 5 years, and now 46%. We have a predictability grade of 4. It is like 4 out of 5. Okay, this is the revenue are predicted by analysts and by the market, and so on. When it comes to debt, I was surprised when I deep dive into Amazon to discover that they don't have that much debt. Okay, for this kind of business, I invest a lot. They don't have that much debt. Okay, the net debt to EBITDA 5 years ago average was around 1, and now it's 0.6, so they are decreasing debt. Debt to equity, same, it went to 100 to 60%, it's good. And interest coverage, so it was 11 and now it's 43, so they can cover by their operating earnings 43 times the interest of the debt. So it's really good. Generally, we want something, we want it to be like higher than 8, so 43 is very good. Now the efficiency is where Amazon have lack of, okay. Operating margin, you saw that it was very little, 3%, 5%, now 9.8%. It's increasing, which is a very good sign. It's increasing. The reason when it was low, it was because most of the revenue were coming from e-commerce before. So most e-commerce revenue, you know how it is. If you check Walmart, if you check Costco and so on, they have little margins. That's why, it's because it's a little margin business. But now they are progressing and they have better margin. Same with return on invested capital. It's growing, which shows also the competitive advantage of Amazon. It was 10% in average for the last 10 years. Now it's 50 to be very good, okay, especially if it continues to grow in the future. Here we have a score of 39%. So for the debt, we have the score of 83% and 100% for the growth, okay? And now the capital allocation is literally where you have the smallest score, 8%, okay, which is really not good. When it comes to share outstanding, I put buyback, but it's number of share outstanding. It grew by 1.2% for the last 5 years in average and still growing now, which is not really good. I don't really like to be diluted as a shareholder, but they have great growth. So, okay, why not? But this is like why this score is kind of low. They also have capex to cash from operation kind of high, 60 and 70%. It's kind of high because they really invest a lot of their cash flow. And also it was a low margin business, so they didn't have a lot of cash. So as soon as they had cash and invest, it will go up, but we'll see after that it can be changed. And same, stock-based compensation are pretty high, but same, it's because they don't make a lot of free cash flows, they don't have high margins, okay? So they give us a quality score of overall 62%, which is not bad, but not really good, okay? I prefer when it's over 75% here. Now we can try to talk about forward numbers. So as it is forward numbers, this is all theoretic, okay? This is not sure, we don't know, nobody knows the future, nobody can predict what will happen, but we can try to see what can fit and what can happen. So in the future, I expect, okay, the operating margin to grow, okay? You have now in efficiency, they are 9.8% now. So in the future, it could grow and have 15% operating margin in the next 5 to 10 years, okay? Same with ROIC. I expect it to continue to be at least 15%, maybe grow. I didn't put growth to grow here, but to stay at 15% and continue this trend because AWS is more and more profitable. Like AWS is growing 20% a year. So this is the growth, and here same for the return on asset. I expect them to grow, which give us a rate of 70%, which is way better than the 39% that we have here. Okay. Now, when it comes to capital allocation, with making more money, more cash flow, and so on, I expect them that maybe they will stop diluting the shareholders. I also expect that Andrew Jassy, which is a new CEO, will a bit do like Tim Cook effect had on Apple, okay, and be a bit more friendly with, maybe start doing some buybacks, but at least stop diluting the shareholders, okay? That's also why they didn't have much debt, because they were diluting a shareholder to have money. I also expect the capex compared to the cash from operation to go slightly down, okay, to probably 30%. Now we're 60% to 30%, I think, like to divide it by 2, it's way more than possible in the next 5 years, okay? And same stock-based compensation to decrease it to 10, 15%, okay? Because now it's 50%, 20, it's very big. So between 10 and 15%, I think it's possible. I think I'm not exaggerating with this, with those forward numbers, which give us a score of 66.7%. And the forward quality score overall would put Amazon at 81%. So a great quality business for me. Every time that it's more than 75% is great quality business. What about the strength of this company? They have massive logistic infrastructure, probably one of the best. They have built an unparalleled network of fulfillment center, delivery station, transportation capabilities that will be extremely difficult and expensive for competitors to replicate. Okay? AWS dominance in cloud computing. As a market leader in cloud service, AWS provides both substantial revenue and strategic advantage in AI, capabilities and enterprise relationships. They also have a prime ecosystem lock-in. The combination of fast shipping, streaming, shopping, and other services create a strong customer retention and high switching cost. Okay, let's say today you have Disney Plus. You're done. You watch all the catalog. You can stop it. But with Amazon, even if you watch all the Prime Video catalog, you will still keep it because you want your delivery to be faster. You won't have to have your one-day delivery. You want to keep this. Or maybe you are listening some music on Amazon, so you want to keep it. With all those things, like it gives pretty good strength to the company. They also have the data advantage. Okay, the Amazon vast trove of consumer behavior data across shopping, streaming, and device usage enable better personalization and product development. Sort of very good for AI. And the innovation culture and technical talent, Amazon maintains a strong culture of experimentation and attract top technical talents, particularly in AI, robotics, and cloud computing. So the future seems very good for Amazon. Now, of course, they have some weaknesses. Okay, we cannot. If you don't find a weakness in a company, you have a problem in your analysis. Okay, you always have some weakness. For now, I would say it's a poor capital allocation compared to other tech companies. Okay, they also have high operational cost, extensive physical infrastructure and workforce required for retail operations result in thin margin and high fixed cost. Okay, they have also workplace controversy, ongoing concern about working condition, union relations, and employee treatment affect brand reputation and talent retention. Also a product category gap. Amazon still struggle in certain and high-end fashion where brand experience matter more, and dependent also on third-party retail businesses relies on independent sellers creating quality control and counterfeiting challenges. Okay, now what is the opportunity for Amazon in this market and for the future? First, the cloud. Okay, 21% cumulative annual growth rate. It's a growing market. AI application, leveraging their data and AWS capability for new AI-powered service and product. I think they are well placed for this. Advertisement on Amazon can be very lucrative, considers that people go on Amazon to buy. You also have advertisement on Twitch, which have more and more users and are doing very well. I think Twitch, they bought it for 1 billion. Now it brings 3 billion in revenue of advertisement. So it's really good. They also have healthcare expansion through pharmacy service, telehealth, and medical supplies. Amazon could disrupt the massive healthcare market. Also financial service. They could expand payment service, lending, and other financial products to both consumer and businesses. Autonomous delivery, okay, investment in drones, robots, and autonomous vehicles could revolutionize the last mile delivery cost. So this is good as well. And of course, improvement in profitability can be very good for shareholder. Now the capital allocation is weak, but they are on a good way to create probably massive value for shareholder. I think the capital allocation cannot be worse than what we had over the past years. So I have good faith in this, okay? What about the danger? If you have opportunity, you have some danger. You have Microsoft and Google, which have very good position on cloud and have very serious competitors. It's good that you have competitors, okay, but we can have like a triopoly between those three companies for the cloud market. You have cybersecurity risk, of course, e-commerce, everything digital. It's a major technology platform. Amazon faces constant threats from hackers and potential data breach. Okay, they have regulatory pressure, increasing antitrust scrutiny and potential regulation could force business model change or breakups. Okay, they could divide in few companies because look, if they are in the financials, autonomous delivery, healthcare, advertisement, cloud, like you may have some problem with regulatory pressure, and they can have some antitrust issues. That's something which seems fair and normal, okay? You have also the labor market challenges, increasing wage pressure, union activity and competition for technical talents. Also, environmental concern like pressure to reduce packaging waste and carbon emission could increase cost and require significant operational changes, okay? Now let's talk about the moat of the company. First is had the grade of wide moat with a stable trend from Morningstar. Why I put it here? Because companies that have a wide moat rating from Morningstar tend to outperform the market on the long run. So this is good to know. They have increasing margin year over year, increasing ROIC, so return on invested capital, which is now 15%. It's increasing year over year, which are two very good signs of moat, okay? So ecosystem. Amazon Prime give a wide panel of advantages that make it difficult to stop the monthly fees. Infrastructure, system that Amazon has developed. You have also the data. Thanks to AWS, its little business policy, they have very big clients and collect a ton on data. Why is this little business policy? It's because when they started, and still now, it was the first where you could pay with credit card, okay? And that you don't need huge contract and so on. So when you're a little startup, a little business, and you have something pay as you go for servers and data centers, it's amazing because you don't have to have a $10,000, $20,000, $100,000 contract while you're just starting your business. You're not making any revenue or anything. It with Amazon, like you pay as you go. If you use it, you pay. If you don't use, you don't pay it. So this was very, very smart of them. So they get a lot of small business. And guess what? Those small business, some of them became very big. And what happened when you have data centers and so on, and you're a big business, you cannot switch from Amazon to something else. So they have a very big switching cost. They're also a trusted brand and a market leader. Like for me, Amazon really are deep into client is king. And I think this is a very good way to do business on the long run. Okay, so we were talking about it. They have a very big switching cost. You don't change your server, data center, and so on, especially when you're a big company. Just for the record, Amazon needed almost 15 years to change from Oracle to AWS. They created AWS in 2006. I think they needed to wait till 2016, 17 or 19, something like this, to finish all the transfer from Oracle to AWS from the data centers and so on. So it's a big switching cost. Who want to spend 15 years to change, to put all your data and so on somewhere else? You don't really want, especially that what other will bring better than what Amazon has actually. So you don't really want to change it to here. So when you have a client, you have a big chance that you have it for life. So this is really good. For another example, it's Netflix. They are still an AWS clients while they're having their own cloud and data centers and so on. You have also a pricing power. They can increase price from this AWS service without client dropping because it costs too much to change. If there is a mistake or data breach or anything like this, it can really create a problem in the company. So they are really protected and have a very good pricing power on this. They could increase the price 5%, 10% every year with not a lot of problem, okay? And then they have economy of scale. They are so big that everything is less expensive for them and they can have a better place on the market. Okay, now let's talk about value of the business because it's after all what we need. It's good to have a great business, great quality, but if the value is poor, we cannot invest. We want to invest in great business at a good price. So the 5 years average PE is 45, so the price earning ratio. The actual price earning is 47 and the forward price earning is 35, which are all quite high, okay? They have a revenue growth expected of 10% per year and EPS growth rate around 37% per year. Let's dive into it. Let's go on our DCF calculator model. First, let's step one, the earnings. So we put the last earnings of Amazon and the last price. So the last price is what, 220. So if we have for the next 5 years, it's expected for the last 3 to 5 years, 37% growth rate. Okay, now let's say that they don't change their policy about share outstandings and they keep producing 1% new shares every year. Okay, it gives us a cumulative annual growth rate of 28%. The fair value of Amazon, if you want to do at least 13% per year, is $413. So we're at 221, pretty good. And this is with a P ratio, future P ratio of 35, which is like the actual forward PE ratio. Now, let's say we put something more than like 30, okay, we'll have 24. We can put even 25, we'll have 19%. So it's pretty good, okay? It's pretty good business and have pretty good like value and shareholder value for the future, especially if they achieve this growth. Now, let's say they don't achieve this growth, we'll put more margin of safety, we'll put 30 here. They will have a growth rate, let's say we decrease it by 20%, so it will be 30% per year, and you don't have any change in the share outstanding. They stop, they don't do buybacks and so on, so it's keep like this. With a PE of 30, okay, you still have 17, almost 18% cumulative annual growth rate, which is pretty good. We can go here, maybe put 25. You have 13.65%, which is also very good. We can put here even less. Let's say in the next 5 years, we'll have only 25% of growth rate. Here we'll have 13, and here we still put 30. If we put 25, here it will be 9. Okay, 9, not very good, but it's still kind of fine. Okay, it's not like it's still fine. And here's with, of course, 25% is big, but most of the projection shows that it should be over 30%, seeing how fast AWS is growing. Okay, now we can maybe imagine that they will, let's say they stop issuing new share with 25% growth rate. We're here, and so it's all the game here of where the PE will be in the next 5 years, what is the growth rate we expect, and so on. So the best way to use this is we could do like a reverse one, to like, okay, in which scenario 221 is a nice buy if we want to have 13% growth rate, okay? So we can play with this. We can say, okay, here we keep 0.01. So apparently 25% growth rate, 30 as a P ratio is good, okay? Here we can put maybe if we have a 20% growth rate, but here it's 35, where we'll be almost at 30, okay? So when we see all of this, like the value seems kind of fine. I think we don't have a business which is way overvalued, even if it's an all-time high. So if we look at all the scores, the quality score is 62, the forward quality score is 81%, and the value, for me, I give it a score of 75%, which is quite good. So to conclude this video and this analysis, if you have a pessimist view, growth rate around 8.99% for the next 5 years. Okay, not really bad. Probably, we don't know. Maybe it will beat the market with this. We don't know how the market will go, but it's this. If you have a neutral view, okay, it's around 13% for the next 5 years, which is good. And if you're optimist, it's over 20% for the next 5 years. So seems pretty fair, okay? Today, AWS is a gold mine for Amazon shareholder. Okay, they have a very strong mount, and Andrew Jassy seems to be the right person to develop Amazon shareholders' profitability on the long run. He developed AWS very well. He's in the company since years and years and years. It's almost the foundation since the IPO is here. So I think he is a good guy to bring some good shareholders' value. Okay, they have a good position in AI and of course in cloud. Now let's see the bear cases, okay? It's Amazon mentality to spend a lot on CapEx. The comeback of Jeff Bezos could slower the earning growth and probably will not see any buybacks because of this. But we will see, okay? This is the future. We don't know. I'm not a big fan, of course, of diluting shareholders, as I told you. They have some inconsistency in the profitability. Remember in 2021 where it decreased. Okay, on the long run, it's growing, but they have some inconsistency, so don't really like it. My personal belief here is 2.3 trillion market cap seems low compared to other tech company, particularly when we look at all the business where Amazon are involved in and the quality of the business, the positions that they have and so on. I believe that they can create great shareholders value and they should have a higher market cap. Okay? So that's all for this video. Let me know what is your thoughts on Amazon in the comment section. I will be happy to read it and also to debate on this company. If you have some companies that you would like me to analyze, leave it in the comment section. Can I like to share some investment ideas? So leave me all of this in the comments and I'll see you in another video. Bye.